Okay, welcome everyone. So I'm Dave O'Hara, broker, Diamond Realty and Loan. We get together and do these webinars, workshops, the first Monday of every month. And generally at 4 o'clock. I had an appointment, had to run a little bit late today, starting at 4:30. We usually go about 30 minutes or so. So feel free to send questions in if you have questions, kind of thing. But the topics come up from you sending ideas in. This month we're doing interest rates. What's up with interest rates? Mortgage rates are different from auto and credit cards and all. But really, what makes up an interest rate for mortgages, for home loans? So we're going to dive into that. But again, if you have questions, feel free to send them in. So, of course, interest rates to start at the bottom rung of a ladder, right? Interest in and of itself is so that the investor gets paid for giving the borrower money. Borrower doesn't have the money, they want to get this product, so they have to pay a little extra. That's the interest rate. That's what the investor gets. Now, we'll talk more about how interest rates fluctuate and things like that. But in reference to mortgages, mortgage interest rates are market driven. They change by the minute, by the hour, certainly by the day. And lots of other interest rates, like your credit card, as high as it is, wow, they don't change quickly. And certainly when they go up, they change faster than when they come down. But we'll talk about the rationale and connection and relationship to that. But more specifically, mortgage rates are dependent on mortgage-backed securities. Now, MBSs, we'll refer to those simply as MBSs from now on. That's much easier than mortgage-backed securities. So that's a bond, and that is a bond that is made up of a whole bunch of mortgages. They're bundled together and put into an MBS. That MBS then is offered on the market, worldwide. And remember, America's MBSs are considered pretty solid, pretty stable. So lots of other countries will absolutely buy mortgage-backed securities from us because they're stable and well known. But that MBS is made up of a whole bunch of mortgages. Now, when those investors are going to buy that MBS, they're going to look at duration. So is this bundle, is this package, this MBS, 15-year, 30-year mortgages? What is it involved in? What's in it, as well as what's the range of credit scores? What's the range of loan to value? These types of things. So they're going to look at this for their repertoire, for what they are looking for. Of course, investors are getting into these mortgage-backed securities because they're safe, right? They may be able to make more money on something else, but that's up to them to decide whether or not they want to get involved in that. And interestingly enough, that as mortgage-backed securities prices go down, interest rates go up for home loans, and vice versa. There's a very interesting inverse relationship between the two. And you can figure that out and see it because, they're trying to increase the demand, right? So interest rates are going up, which pays them more. Yeah, let's not make it too terribly weird. Okay, so next topic. Okay, the feds. So I get calls often, questions often of, hey, the federal funds went down a quarter, so surely mortgage rates are better. Okay, so the feds have two mechanisms to influence the economy, but everything they do is short term. So the federal funds rate currently about 3 5/8, 3.625. That is the interest rate that banks lend to other banks. So when bank needs their additional funds to hit their reserves for overnight, and they don't have it, they can go to the window, borrow money for overnight, and that's the interest rate they're paying. Federal funds rate is bank-to-bank rates, but that's a very short-term interest rate. So it does influence then credit cards, home equity lines of credit, and those types of things. But it only minorly influences mortgage rates. Mortgage rates, although it does get influenced by the feds, Mortgage rates are more about that particular MBS or mortgage-backed security, and how much somebody wants it. For instance, side note: Japan has more U.S. debt than any other nation. They've bought more U.S. debt than any other nation. Part of that is MBSs because they're so stable. Interesting side note that Japan is not even probably, of the industrialized nations, they are the most in debt country, period. 230% of GDP. What does that mean? The total gross product that country, Japan, produces a year, they owe over 2 times that in debt. Yeah, it's amazing. That's a side note, but part of that, I bring that up because part of that is, if they're buying mortgage-backed securities and they're that far in debt, they must really believe in A, the relationship, and B, the solidness of that security. So, okay, so back around to federal funds. So the feds have 2 mechanisms. One is their interest rate, right, 2 5/8. But then they have their balance sheet. So their balance sheet is heavily influenced or weighted with mortgage-backed securities. So quantitative tightening is when the feds either increase interest rates, federal funds rate, bank to bank, overnight rate, or tightening, or let things roll off or sell off of their balance sheet. So they currently have $2.3 trillion worth of mortgage-backed securities on their balance sheet. And they're letting about $35 billion run off per month. So as they are not buying, they're letting it run off. It falls off their balance sheet. So that's stuff that's going into the open market, right? That definitely influences interest rates, as does inflation. So remember, federal funds mandate is inflation and employment. So employment's currently at about 4.4% unemployment, which isn't bad. Clearly you want it less than that, and it's been going up a little bit. But inflation, the core inflation is about 2.7%. Now, some of you may recall the 2% goal, right? But you gotta remember, the 2% goal was when Greenspan was the federal funds chairman, and he whispered, if I was really trying to make it a number that we were aiming for, I think I'd probably go for 2%. But I hope that never gets out to the public, because then they'll hold us to it. And that's the story that has been circulated often in talking about economics and policy in reference to the Fed. But he said 2% isn't really the target, but if I'm pushed, okay, maybe today. It's a whole feel. And so, the fact that Powell is really pushing to get back to that 2% or 2.7 is a bit of a misguided principle in reference to Greenspan and many other economists that I listen to. But why do I bring all that up? Because interest rates are heavily influenced by the Fed, but they're certainly not posted or made by the Fed. Banks don't even make interest rates for mortgages. Banks do for cars, credit cards, washing machines, consumer goods, but not for mortgages. Mortgage interest rates are the MBSs, the demand, and then, of course, you always have to look at the file in and of itself. So when you have when you have a loan, you have a start interest rate, right? It might be whatever, let's call it 6%. And then you're going to look at income, credit, collateral, right? These kinds of things. If the debt to income ratio, the amount of money that the borrower owes, right, is elevated, then that could have an influence on the interest rate, and rather the price of the interest rate. If 6% is a par rate, it's not paying or asking, right? Or you could have 6.5% and they'll give you $1,000 towards closing costs, right? If 6% is par and you have an adjustment for DTI, debt to income, then now 6% is going to cost you a little bit of money. So you got to raise it up in order for it to be a par rate so it doesn't cost you money. So debt to income ratio, loan to value. Interestingly enough, most people always think you want to put 20% down so you don't have mortgage insurance. And yeah, mortgage insurance is an expense, but it also is a wonderful thing because it allows you to get a loan, because investors don't want to risk the whole thing. So they're willing to risk 80% if you're putting 20% in. If you're not putting 20% in, they don't really want to do the loan. That's why they have to have mortgage insurance. Rather, that's why you have to have mortgage insurance. So mortgage insurance allows you to put less than 20% down because now that insurance company is backing that top 20%, right? Now that is an expense, but back to interest rates, because there isn't 20% down, but there is mortgage insurance, which guarantees it to 80%, the interest rate could be less than if you were even at 80% and did put the full 20% down. Very interesting. So that can also do it. So that's DTI, LTV, loan to value, right, and debt to income ratio. And then you look at the type of property, so collateral. And if the collateral is an investment property, you're less apt to pay an investment property when you're in trouble than you are your primary residence. So investment properties are going to have a pricing adjustment in reference to that interest rate, right? And then lastly, of course, is your credit score. And pretty much anything over 740 credit score is golden. Interest rates are the best and there's no negative adjustment. But anything under 740, depending on the loan structure, may have an adjustment for the price of the rate. So, okay. All right. And so let's compare mortgages to credit cards. So how is it that I could have over 20% interest rate on a credit card, but a mortgage at, say, 6%? Well, a mortgage is in reference to real property. It can't move. It's stable. It's there. Even if you don't make the payments, you're not going to be able to move the house. So the investor can come and simply take their collateral back. But with a credit card, it's revolving. It has no collateral. There's nothing behind it. And so it's the most risky loan. So they're going to get the highest return. So totally different, right? Also, let's compare it to a car. Car's a little closer in idea because it is, it's an actual physical thing. But remember, house, stable, it's right there, can't be moved. Car, it can move, it can go away. Investor probably wouldn't be able to find it if you didn't want them to. And real estate appreciates. Remember, prior to COVID, the national appreciation for real estate for 40 years prior to COVID, 4.2%. And that's 4.2% on the entire value of the property, not just what you invested in it when you bought it, right? But a car, that's a devalue and a depreciating asset. Can't even really call it an asset because if it's losing value, how could it be an asset, right? But loans on an automobile generally are going to have a higher interest rate. Now, there's lots of dealers and manufacturers that will offer a low interest rate. And that's simply to get the business. They'd rather sell the car, maybe not have market rate. Maybe it should have been 6 or 7 or 8%. They're offering it at 3, 4, or 5%. But that's to incentivize selling the car. But that's not really the market rate for that commodity. So there is the big differences in everything. Generally speaking, the most risky would have the highest interest rate, the lowest risk, particularly in reference to property, real property, housing, because it is appreciating. The value is going up. The investor is in a pretty solid spot. So generally speaking, that would have the lowest interest rate of all the other markets available. What else did I want to chat about? Oh, yes. So, a lot of people, and the time is coming, and I have a whole board of loans that I watch, but the time is very much coming that a lot of people are going to want to refinance. Of course, Kevin Warsh is our new federal fund president chairman, and he takes over in May when Powell is done. Whether or not Powell's going to retire and go on the wayside or stay on the board, we'll see. That's beside the point, but it does sound like Warsh is he's probably a little more aggressive, and I think he likes to look at the whole picture instead of just the rearview mirror stuff, the things that has happened. It's a hard way to. It's impossible to drive very well if you're always looking in the rearview mirror, right? And that's part of my argument with the feds. But interest rates most likely are going to start coming down, and they have been, but just never in a straight line. But remember, it's much better to have a strategy that you adhere to than specific and wait for the rates to come down. When they get to the bottom, you never know when the bottom's there. So just for simple numbers, and you can test my math, but it's right. On a $500,000 loan, it's about $1,900. It depends on where the rate is changing. But if you're going from 6.5% to 6%, right, that's a difference of about $1,900 a year. So let's call it $1,000 per 6 months. If you are waiting for that 5.5 rate and you have a 6.5 and it comes to 6, you don't know when it may or may not get to 5.5. You don't know. You know that if you did it right now, you would save $1,000 in the next 6 months. If it took 6 months to get to the 5.5, that's $1,000 you would have lost. You would never be able to regain. So it's better to have a plan. Don't just look for an interest rate or just wait for the bottom. If that's something that is in your future, and half of the nation does have an interest rate that is over 5%. The other half have interest rates below 5%. It's very interesting. But we just did hit the equilibrium point. So always have a plan. It's not always rate. A lot of it is strategy, positioning, timing. But I like to tell all the borrowers I deal with, have a number that you're set on, and when it hits it, bam, take advantage of it. And then set another number. And when that gets hit, if it does, boom, hit it. But if your number is under 5%, you're probably never going to refi. I don't know for a fact which way rates are going to go. I just know they're either going to go up or down, one or the other. They always move. But under 5%, that was irresponsible for the feds to have allowed interest rates to be as low as they did for so long during COVID. That was a mistake. I don't think they're ever going to do it again. So with that in mind, always feel free to, share, comment, follow, all of those things. I appreciate everybody that attends. And you can come to the visitor center and attend in person as well, if you like. If you have questions about today, or you just want to do a one-on-one chat, always feel free to direct message me, email, call, whatever is convenient and best for you. And send in more suggestions of what next month's chat will be about. I do have a few on the list that have been sent in before. I thought this was timely, interest rates. So I hope you enjoyed it. Hope it was fun, informative perhaps. Thank you. I'm Dave O'Hara, broker with Diamond Realty and Loan. See you next time.